Let's focus on Mahindra and Mahindra. Third quarter was a healthy quarter for them. Good improvement in margins, strong volumes for the auto and the tractor segments. Tractor, especially, lots of focus in terms of how that segment is coming up over the last couple of quarters and maybe over the next few quarters as well. Let's talk about what's sort of gone on and, of course, what's the future looking like. We have Anish Shah, Group Chief Executive Officer and Managing Director at the Mahindra Group, with us here in our studios. Anish, great to have you with us here on the program. Thank you very much for joining us.
Good morning. Great to be here.
It's a pleasure to have you with us here in person. Yeah. So that makes all the difference. Let's just start with, I want to start ahead. We look back in a bit. But 14th of February,
what a
Valentine's Day, and you're opening bookings for your EVs as well, right? What's the expectation like? And it's going to be available across, 200 plus dealerships?
It is, because we were first planning to have it with a select group of dealerships. But just given the level of demand we've seen, we've had our dealers from all around the country saying, you cannot leave us out. You have to be present everywhere. Okay. So it is about unlimited love, as we've talked about, and therefore Valentine's Day is a perfect day.
Who's the buyer going to be, in your opinion? I mean, what kind of demand are you expecting? Just talk to us a little bit about that. I mean, what's the internal sense as you open bookings? Yeah.
Based on the test drives we've done, we've seen a very, very strong positive response. And the buyer actually cuts across multiple segments, because this is a vehicle that has everything from a quality standpoint, a technology standpoint, very well priced. And therefore, it really combines a lot of attributes that a number of buyers look at. Electric is going to be something new, because this is going to be, in our view, an inflection point for the country to start moving towards electric at a faster pace.
Any numbers, projections in that sense?
What's the capacity? What is the total number of units you could sell
so
monthly basis?
Our capacity that we've set up is 5,000 a month right now, which is a fairly healthy capacity. And then we will expand it to potentially 10,000 as more electric models roll out over the next 12 to 18 months.
So there's so much excitement about these models, right? Fair to then ask you the cannibalization question as well. But at the end of the day, if I want to go to the market and buy an M&M vehicle, I'll think, I have to choose between ICE and your born electric range now. So will it kind of, one feed off the other to an extent? So in terms of volumes, as this starts scaling up over the course of FY26, what are you expecting in the SUV portfolio?
So if you look at the last 3 or 4 years, we've had some very good successes. And we've essentially been cannibalizing all our competitors' volumes, not our volumes. So some of it might rub off here as well.
Okay. But, the other excitement that the market has around this is that what it does to the overall margin profile. Anyway, you've had a great performance in the third quarter. Overall margins have been going higher. And these are coming at a very different price point, right? The electric vehicles, 25 to 30 lakhs, probably a new category of buyers also opening up. So on margins, as the scale-up continues on the SUV portfolio, or let's say the auto portfolio, not just SUV, what is the projection in terms of margins a couple of quarters down the line?
So margins will be slightly lower to start with, because you would expect that with a new product, also because it's electric. And we will be showing margins separately for ICE versus electric.
Okay.
And over time, they will catch up, because that's where the investments come in for. And we would expect margins to be similar to ICE in the longer run, but it will take us time for us to get there.
And what you describe as longer run? I mean, just till this kind of evens out.
I think a lot depends on the level of demand that we see and the capacity utilization that we'll see, because that's going to be a key driver of that margin as well.
Okay, all right. Good to have you in the studio, Mr. Shah. Since you spoke about y'all are grabbing market share, I've observed that actually in all the three verticals. I think in tractors, you're at around 44%. In PVs, you'll have increased your market share. And LCVs as well. I think that's, came down a little bit in the last few years. It's back at around 45%. Could you tell us?
51.9%.
51.9%. All right. You'll pull back the margins, the market share out there. Could you tell us what is a sustainable number? Because I think tractors, it was in the low 40s, 40, 41%. Suddenly it's moved to around 44%. Do you think you could hold on to these numbers?
So we don't push for market share, especially when we are in the 40s and 50s.
Okay.
For us, it's more important to execute well. Okay. And the messages to the teams are continue to execute well on the ground, continue to provide the customer what they want, and market share will follow as a result. When we are in the low 20s as in SUV, yes, we are going for market share, and our products as they come out will gain more share. But that's a difference that we have in place.
So in SUVs, what would the target be then? PVs as well. And if I look at it as an absolute number, I think it was mid-single digits. That's moved to early teens. Where do you head out there?
So our target, and we have been fairly audacious in what we do, is to get to 40% in every segment we play in. So yes, we have a while to go, but that is part of the journey.
Okay, all right. Since the one that you're already at 40% is the tractors one, and that's where you'll have, hold of the market. And I was looking at a Jefferies note. They're saying that, the tractors market has seen a little bit of a lull, but now things are looking up. And I think you briefly mentioned that as well in your call. Do you think the tractors market now, the industry on the whole, is set for better times? And if that is the case, should we be looking at mid-teens growth for the next few quarters for the tractor industry?
So we do see a lot of green shoots in rural, as we've talked about earlier as well.
Yes.
For the fourth quarter, we expect 15% growth year over year, and that's a very healthy growth in this space. For next year, a little early to say as yet, because it will depend on this particular season and how that goes as well.
Okay.
But overall, we remain fairly optimistic about where rural is right now and prospects for a tractor business next year.
Anish, let me pull back a little bit, and we'll come back to individual segments, etc. as well. How important is this entire? How are you viewing all this tariff noise in that sense? So to narrow it down, I mean, there's been a lot of chatter that there could be some safeguard duty on steel, which could come in. And I mean, it's always, we start every Monday thinking, well, it's going to be this week. So who knows? But if that were to happen, especially on the tractor side, I mean, steel, I think, is by far the most important input, right? Does that as an automaker, does that impact margins a little bit? Will you be able to deal with it? Whatever happens. I mean, 10% is what is being spoken about. What's the sense?
So the focus on steel, as I understand it, has been specifically on dumping from China.
Yeah.
Dumping is clearly something important for us to take care of. But at this point, we don't believe it's going to go much broader and have a complete discontinuity in terms of steel prices in India versus the rest of the world. The reason for that is it will impact all the user industries, and it will stoke inflation in a much bigger way. So it may take away a lot of the good work that's been done to create the demand stimulus, because steel is an important material, not just in auto and tractors, but across many, many industries.
So it's about 7.5% right now. Say you slap another 10% down. So roughly 5,000, 6,000 rupees is what we're looking at. And it'll, as you said, affect everyone if that were to happen. But will that, you'll be able to sort of pass this on? What would be the strategy?
Typically, it would be passed on to consumers. Now, if you look at our overall consumption, 93% of the steel we buy is from within India. And most of what we buy is not manufactured in India today. So while it is, I think, absolutely the right thing to address dumping, as long as it doesn't change the dynamics overall, because that takes away from the whole Make in India story. Make in India means we've got to be able to produce in India at the lowest possible cost.
And be competitive.
And be competitive in that sense. So as long as we're competitive with global markets, I think we are in good shape.
What about?
So, since we're talking about passing on any potential duty increases to customers, if I could just bring in on the point on pricing, overall realizations were up around, I think, 2% in the quarter gone by. The street might have sort of hoped for slightly higher. I think you're at around 88,860 average, pricing, the blended that is. How much elbow room do you feel that you have in your different segments, if you go piece by piece, in tractors, in SUVs, in LCVs, to take price hikes going forward? There was one in December, but what's the projection now looking at this year?
I think a lot depends on each product, each segment, each geography. So it's not something I'd look at overall.
So individually, if you could give us an individual sort of idea or an overview on these
I think
segments.
on a broader basis, there's some elbow room because we've been performing well across all our segments. Our capacity utilization still stays close to 100% despite tripling capacity in auto. So from that perspective, I think we are a little better placed on that front.
More elbow room in tractors or in the auto segment to hike prices?
I think that's a conversation we would have once we need to do it. Okay. At this point, we don't see the need as much. But if that does come up, then we will look at it.
Anish, just to finish that tariff point, Prime Minister Modi is in the US meeting President Trump. How important is that going to be? Because there's all this talk of reciprocal tariffs. What would you watch out for, really, in that sense?
I think it's an important relationship for us, and the US has been a key partner for us in many ways. The one advantage, in a sense, India has, which is not a great advantage to have, is that we haven't exported a whole lot compared to other markets. So from that standpoint, we will not get hurt as much by tariffs. And therefore, this is the time for India to really focus on manufacturing and make in India. And as we do that, we will have more competitive products, and there are many markets around the world where we can send them to. This is where FTAs come into play as well, and I know the government is pushing that in a much bigger way. So overall, I think the US relationship is an important one, and from that standpoint, I think this is an important week for us.
The Tesla question?
Exactly. I'm glad you asked that. I thought that has to come up in those conversations, right?
Do you think that'll be part of the, more access, lower duties, lower tariffs, and how's the industry looking at that?
As we've always said, we welcome competition. We've gotten better with competition. And as you see our electric cars, in fact, when we had our launch, we had our car next to 5 major makers in the world, and we had media and analysts and investors drive all 5 cars. We had an external agency rate all 5 cars. That included Tesla as well. And we came out very well. So we are happy to have competition in India. It will help the electric segment grow as well. The key for us, as we've always maintained, is that what we've seen the government do is take all actions that essentially foster make in India. That's the most important part. If India becomes a dumping ground for the rest of the world, whether it's in steel or automobiles or anything else, that's going to be negative for the economy. So as long as every maker in the world is making in India, that's a better outcome for us.
Perfect.
So, I'm just rounding off with, I'm reading out a brokerage note. Those are the tall expectations the street always has from M&M, and you've been delivering. This note talks about a CAGR of 15% at the top line, maybe 19 to 20% at the EBITDA and the PAT line over the course of the next 2 years. Doable?
So I just want to first say that M&M actually plays in 70% of India's growth, not just in auto and tractors. In fact, if you look at our services businesses, they have contributed very significantly over the last few years. And in fact, based on the data we've shared, they actually had more cash generation than either auto or farm. So that's what's been driving our growth. If you look at numbers for this quarter as well, Tech M, Mahindra Finance, our growth gems, have all contributed in a very significant way. Mahindra Finance up 47%, our growth gems up 33%, Tech M on a good margin expansion path. So all of those things are really what's driving M&M forward.
All right, Anish, a lovely chat, great conversation. More questions, but we'll save it for the next time. Thank you very much for dropping by. It's always a pleasure to have you with
Likewise,
us,
thank you.
In the studios. Well, that's the top boss at Mahindra Group with perspective on growth path from here, and of course a little bit about all the noise around tariffs, etc. as well. So more competition welcome, but sell in India if you make in India. At least that's essentially been the government's thrust focus, and he hopes that continues.